Welcome to Financial Revelations. I am David Safransky, your host this week and every week. At some point in time, I'll probably have a guest host. It's hard to find somebody as good looking and as knowledgeable as me to replace me, so I'm still searching. I don't know if I'll ever find that person. You can reach us. You could send in questions, and we did get a few of them last week. Joshua at EPSF.com. Joshua at EPSF.com. And then on Twitter, and I really want you to follow me there. I want you to go to Twitter. Elon Musk is buying it. Free speech will prevail. I hasten to put too much faith in any one person, but you know he's pretty much a genius. He is a genius. NASA has been trying to develop a rocket for 50 years that he did in 3 years, and it can land itself and be reused again. It's really quite incredible. If you ever get a chance to see these rockets land, you can get them on Twitter, actually. There's a lot of pictures of them coming out of orbit, coming through the atmosphere, landing on a barge in the middle of the ocean, right where it's supposed to land. It's really quite spectacular. So I am going to put a little bit of faith in Elon Musk and Twitter, and I think it's worth a risk for you too. So at SkiBucks, the number 1, Josh is going to put that up for you so you can see it. So today, I'd just like to go over the basic facts of the letter that I put out to all of our clients yesterday. About quarterly or a little bit more than that, I like to communicate with everybody just so that people can have a heads up as to what we're thinking and that they can see in their portfolio. As you know, the markets have been really rocky. There's been a lot of downside volatility. I want you to remember, volatility works in both directions. So if you had your average right here and your returns were up here, it would be volatility to the upside. If they're down here, it's volatility to the upside. But volatility is really how far you move away from your average, your mean. And right now we have a lot of volatility going to the downside. And there's a couple of reasons. One, the consumer price index came out and it was hot. It's super hot, 8.3% year over year inflation. We haven't seen these numbers since the early 80s. And it scares people. And it's making life really expensive for a lot of people. You think about somebody who lives on the margin. You know, they might be making $20 an hour, but they've got a rent payment that's gone up. They've got a food budget that has gone up. Their gas budget has gone way up. So all the wage gains that we've received, about 5%, we're actually still underperforming the cost increases. So we're losing money. There are no wage gains this year. For most people, they're actually losing money this year. So no wage gains, wage decrease because of inflation. And then today's May 12th, the producer price index, think of this as what's coming. That's what producers are paying for wholesale items today. So there's no markup to the consumer yet. That came out at 11.1%. That is really a scary number for the market. What it says is the Fed's going to have to be way more involved, and we'll get to it in a second, but I'll give you my impression on how the market's going to absorb that. And then you add to that, fuel prices are about 46% higher in the last 6 months. They're double this time a year ago. Energy prices in general, not just gas and diesel, but natural gas, coal. If you took the equivalent of a barrel of coal versus a barrel of oil, a barrel of coal, that equivalent amount would normally sell for about 1/5 or 20% of a barrel of oil. So that would make a barrel of coal about $20. It's $100 right now. And that is not going to stop. England, for instance, their energy bills are more than double last year. And in England, electricity will be about 25 to 40% more expensive by summertime. That's just a month and a half away. By summertime. In Japan, the government is asking people to please turn off your heated toilet seat because it's taking too much energy. I don't know if you've ever sat on a heated toilet seat before, but It's easy to get used to, especially in Cleveland in January. That's how expensive energy is getting. And remember, there is some component of Ukraine here, but in the United States, energy prices were already near doubling because there is an all-out assault on fossil fuels by this administration. They just canceled yesterday the land drilling leases, the ocean and land drilling leases on over 1 million acres in the Gulf and in Alaska. Just canceled them. It's not going to happen. That is not going to make oil and energy prices go down. Their goal in the administration is to make energy prices higher so that we're forced to use EVs, electric vehicles, and windmills and solar. The energy from a windmill is spotty. The energy from solar is spotty. It's always backed up by fossil fuels. And fossil fuels are cheap, they're easy, and they're plentiful. And every country that is a fossil fuel heavy user are the most developed countries. We're living longer, we're eating better, we have cleaner air and cleaner water than ever. It's never been this clean, and that is with our fossil fuel use. Fossil fuels make all that possible. And the more we get away with fossil fuels, the more people are going to suffer. And you can mark my words, if we continue on this green energy binge and this green energy push and this green energy lie, people are going to suffer. You're already seeing it in countries where people can they're having to make a choice now. Do I heat my home or cool my home, or do I eat? And that's going to continue. So that all being said, I believe that we're way nearer a bottom in the market than we are anything else, because what I'm seeing is I'm seeing some consolidation attempts in the market where we're kind of bottoming out, usually early in the day, where we'll see right off the flat line, either a little bit above or a little bit below, and then we'll take off in one direction or the other. But I am seeing these consolidation attempts, and for me, that's a green shoot. I'm starting to see a lot of value in the market. I know the Fed is going to come out in June and they're going to raise a half a point or 50 bips if you're in conversation at a dinner party. The market is expecting that. They might even be expecting 75 basis points, but we're going to get 50 because the Fed doesn't want to make a policy mistake by going too fast with too much rate increase. So there's a little bit of an absorption concept here where if the Fed raises rates today, it takes 3, 4, 5 months for that rate hike to actually filter through the economy. So we don't know that last 50 basis point rate hike. We don't know the true impact yet for a couple more months. So they've got to go slow, because just like inflation is hard to slow down, deflation is really hard to pick back up from. So I kind of feel their pain right now, because last year we were still giving away money. It would have been pointless to raise rates into that. So they did get started later. Not totally their fault, but they did get started later. But we're going to see what the impact is. We're already starting to see the housing market slow down. In fact, mortgage applications for fixed rate mortgages are way down and variable rate mortgages are way up. And so we're starting to see people are making the adjustments in real estate. So for the next rate hike, what you're going to see is, yes, less fixed rate mortgages, and you're going to see less variable rate mortgages. They're just going to slow, and that's going to happen. You're going to see home prices probably start to moderate a little bit and maybe even come down in some areas. Inventory is going to rise. So earlier in the year, there was about 2 or 3 months of available housing inventory. Now there's about 4 to 6 months, especially in some areas, not California, but some other areas. And so as you see that happening, I think you're going to see CPI kind of flatten out around October, maybe September, October. But you're going to see fuel prices continue to move up. Self-inflicted wound. There's nothing we can do about that. We could, 2 years ago, we were an energy independent country. We were actually shipping energy out. And it would be a lot easier for Europe to get off of Russian oil and gas if we were shipping them liquefied natural gas, which we could do. The administration stopped construction on 2 liquefied natural gas ports just last month. Again, another self-inflicted wound. They want to make sure you don't have a choice but to use an EV or solar or wind. It's just solar in Cleveland isn't going to really work in the winter. This is one of the cloudiest places in the country. It's sunny today. We'd have plenty of power today, but maybe not tomorrow. I think Russia's going to continue to escalate this battle, and they're going to be isolated continually. So at some point, Germany is going to get off Russian oil and gas, and prices for oil and gas are going to go even higher. One of the things about Russia is that they're not having success. Their conventional forces were not ready for prime time. And I think we, the United States and the EU countries, really expected Russia to take a piece, roll over, and then we were going to go on. And when that didn't happen, we kind of got dragged into it. And now it's protracted. It could take a while for Russia to do one of two things. Either, I don't think they're going to win the battle because their conventional forces are too deteriorated now. And they went into it in a deteriorated state. They just didn't think the Ukrainians had to fight, but they do. So they're either going to have to find a way to back out and say our objectives were achieved, or they just go into a slow slog and keep what they have and kind of keep trying to chip away. And I think that's more in their nature. So I think this is going to last for a little while longer than what we had hoped, certainly longer than what the Ukrainians have hoped. But I got to agree, when you can get your enemy bogged down in something like this, you should take the opportunity, and that's what we're doing. So in June, July, August, I think the polling numbers for the Democrats are going to come out and will solidify the notion of heavy losses in the midterms for them. And the market is going to love this news. And the market, for the most part, is politically agnostic. They don't care. Really what they want is they want gridlock so that the government can't come after people like them or enact new tax laws or go after capital gains or 1041 exchanges or something like that. The market loves divided government. And essentially, the midterms, if it goes the way it looks like it's going right now, will officially be the death nail into the Biden presidency. They're still going to have a lot of power through executive action. They could still cancel oil and gas drilling leases. They have that power. They're going to be able to do that. But they're way more limited in what they can affect. So the market's going to love that. That's why I really do think that we're starting to form a bottom, and it's going to start to rebuild. I'm not saying take off or go back to the old highs, but I think we'll start to rebuild towards the end of June, early July, that time frame someplace. And eventually a new power structure is going to come in. It's going to be 3 years from now. And that could equate to a new bull market, because once the Fed gets to where they're going, so they're going to raise rates probably 4, maybe 5 more times. So we've got at least one more 50 basis point hike, maybe 2, depending on what the CPI numbers do. But let's say we have 3 more 50 basis point hikes, and then we got a couple of 25s in there to equal 5 more hikes. The Fed gets there, and then they stop. Now we have an opportunity to look at municipal bonds, corporate bonds, some high yields, and we can diversify away from the stock market so that when the Fed says, okay, we got to where we're going, we can come off of it a little bit. Bonds then get capital gains, and now the push and pull of investing really starts happening, where the bond market is a viable choice for some of us because there's yield there. For the longest time, you could buy a corporate bond and get a 1% yield. Well, for 10 years, 1%, I can't do that. It's almost malpractice to do that. But I understand that a lot of people don't want risk, so they had to do that. But those people are also learning right now that the bond market has risk to it, because April was the worst month in the bond market in about 20 years. So people lost money in the bond market. So I do think we're going to rebuild. I think it's going to be slower than what it has been in the past, because we are going to have higher rates. That makes doing business a little bit more expensive for a lot of people when they're doing it on borrowed money. But we're close. And the trigger discipline right now is finger off the trigger. I don't want to be selling into this because I think there's capitulation has happened. and we're starting the rebuilding process as we speak. It's just going to take a little bit of time. So I want you to hang in there. Keep the faith. Stay strong. If you need something, I want you to email Josh. You can also throw questions at us on Twitter. I can't guarantee they'll get answered there, but they could. Email us. You can call us. If you want to be on the newsletter that comes out about quarterly or a little bit more, you can ask Josh to put you on there, and we will do that for you. I am David Safransky. This is Financial Revelations, and I will see you next week.